small.
I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hey,
I'm so mad. The yield curve. We had so many things, Sony, that were supposed to go wrong. I'm an angry bear for Halloween. What are you?
I am doing my debasement theme, but I want you all to meet. Say hello to my friend Skelly. So Skelly's right here, with the gold chain. So I'm going with that meme with Powell going, money printer go brr. That's basically it. As the whole debasement thing. And by the way, there's this gold thing. It goes round and round too. So we'll talk a lot about debasement, especially when Warren comes on.
Oh, that is moving. Was that moving earlier?
Yeah, it's moving. It's moving.
Okay,
that's moving. There you go.
It is.
I'll just keep rotating it.
The angry bear. It's hard to see out of this, so I might have to take him off in a second. But I wore this the muscles.
You've been working out.
Yeah, that's Can you hear me okay when I talk like an angry bear coming through this?
We can hear you. Not too angry, but
no. I mean, you had the ISM sub 45. You had quad 4. You had the yield curve inversion. You had what else made everybody angry?
No, I got one more for you. You got Hindenburg omen. I don't know what that is. I was going to ask Joe what that is.
We're asking Joe about that real soon. Yeah, the Hindenburg omen. Not as many stocks going up, making new highs versus making new lows. Well, we had the LEI negative year over year. You had all these things. They promised me, as the angry bear, I just wanted a recession. I just wanted a bear market. They promised it, Sonu, and now here we are, up over 100% the last 3 years. I'm just not a happy bear.
There you go. I'll just, there's the money printer going. I need to keep rotating this just to keep it going. But
yes, that's good.
By the way, how about that music? I thought there were owls coming and things like that. I was really into that music as for the intro. So thank you to Tori and David, our production team, as well, for getting all this together.
Yeah, as an angry bear, it was good music. Wasn't angry enough, but it was pretty good Halloween music. So that was good. So we're going to bring Joe in first. I guess, what are some things you want to hit on today, Sonu, from the for this live stream? You can welcome everyone to the 2025 Halloween live stream. Facts versus feelings. Really excited to bring on Joe Fahmy here in a couple minutes. And then War and Pies a little after that. What are you looking forward to today, Sonu?
No, just chatting about markets. You and I, we love markets. We have two guests who are really into markets.
So no, I don't love anything. I'm angry. Remember that.
Yes, that's true. I wonder if we'll find out how angry Joe is. But look, markets, we have momentum. We have positive seasonality, right? We have that going for us. We'll talk about the Fed. We'll talk about the White House and trade. And, seems like there are a lot of tailwinds, right? You being a bear notwithstanding here. So yes. We'll talk about all that. I'm looking forward to it.
I do have a tail, but no tail wins. So I think we've gone long enough. I'm going to put this mask up and get a drink of water. I think, Tori, we're probably good to play the intro, and hopefully Joe Fahmy is on the other side of this intro. So looking forward to talking with Joe real soon. Joe.
How's it going, guys?
All right. Hey,
Joe, are you are you professional, or what do you dress up for Halloween?
I'm dressed as a happy bull.
Oh, there you go.
Oh, okay. I thought you were doing a Powell impression or something as well, or best.
Good afternoon. That's the only Powell line I know. Good afternoon. How you guys doing?
That's good. Good. How are you? Thanks.
I was gonna dress as an NVIDIA short seller, but then I'd be shirtless, homeless. I'd be in my mom's basement, so I didn't want to embarrass you guys.
Well, I'm kind of shirtless. This is my real chest, Joe. You like that?
I know it's impressive. Can you breathe through that thing?
Barely. I'm going to take it off in a minute or two.
Like stay alive by the end of this thing. You're breathing.
I see why bears are always so angry. It's like you can't breathe in these things. Well, Joe, listen, we're really excited you could join us. It's the first time you've joined us on Facts versus Feelings, this live stream for Halloween. You know, I want to talk about stuff you do and how you help the community, but let's start with that Hindenburg Omen stuff. Then we'll get into it. I mean, Hindenburg Omens are all over the place. I don't even honestly totally get what it is. It's like a bunch of stocks make a new high, a bunch of stocks make a new low.
I have no idea what it is, by the way.
Apparently, they mark some major peaks. I've been hearing about it for 5 years. Are you worried on Halloween about the Hindenburg?
The only Hindenburg I know is the cover of the Led Zeppelin album. Like,
exactly.
I honestly have no idea what it is either. So
yeah.
I'm not going to talk about something I have no idea what it is.
Well, we do that every week, Joe. What are you talking about?
Well, yeah, that's true. That's what we all do in Wall Street. We talk about stuff we have no clue about, right?
Well, let's go this route then. What does scare you right now on Halloween?
What scares me? Look, I mean, I'm always going to be, when you study the best traders and investors, historically, they always talk about defense in sports. Defense wins championships. You always have to have your guard up and, never be complacent in the markets. But you also have to be very open-minded. I like to look at the positives and the negatives. There's a lot of positives that I've written about.
I love the negatives, Joe. I am the angry bear.
I know. The biggest negative is your costume right now.
Which part of it, right? Like,
that's what worries me. You got to lay off the steroids there, buddy.
Yeah.
No, I mean, you always have to be protective. I mean, this is a bull market. There's always going to be bumps along the way. Whether we compare this to 95 to 99, there were still two big corrections in 97 with the Japanese debt crisis, 98 with the Russian debt crisis, long-term capital. So there can always be bumps along the way. I mean, even if this bull market started in 22 or 23, we've had a couple of bumps along the way. We had a tariff scare earlier this year. So it's not going to be a smooth ride, but overall, the positives outweigh the negatives right now.
Do you worry that, or do you, I guess do you care that, a lot of people say, oh, this is a bubble. It's only the Mag 7. We don't think it really is, but still, right? Do you think it's just a Mag 7 or, does it matter if it is?
I think there's a lot of growth themes out there. And I think one of my favorite quotes is the Paul Tudor Jones, you have to adapt, evolve, or die in the markets. And the big word in that is adapt. I don't understand people who are always bullish because there's periods where we go through bear markets and recessions and so forth. I don't understand people who are always bearish because there's periods where the economy's booming and the market's good. So I like to be flexible. I've studied some of the best out there. And, another Stanley Druckenmiller quote is one of his greatest assets is his ability to change his mind. So I think it's important to be flexible. I mean, to directly answer your question, there are a lot of growth themes out there outside of the Mag 7. Yes, it's AI and all the benefits that happen from AI with chips, with software, with data centers, with energy and alternative energy. But there's also other themes and space themes and quantum computing. There's other growth themes and potential out there that I don't think it's just the Mag 7. I think this is more broad-based than people realize.
And you have growth themes usually in a bull market, right? It sort of corroborates the fact that we are in a bull market. I feel exactly what you said, right? Yeah. If we do have these growth themes playing out, I mean, that's what you would see in a bull market.
Yeah. I mean, just like in the .com, it wasn't just the internet. It was, Intel was putting the chips on the computer. Microsoft was the software, Dell and Compaq and Gateway were the box makers. Cisco was connecting them all together. So, and then you had, fiber optics and high speed and all this. So there's a lot of benefits from AI. I think I even tweeted out that Jensen Huang is single-handedly changing the market caps of so many companies because of the whole ecosystem that he's creating at NVIDIA. So I think that should be applauded, not criticized, even if you are angry.
Well,
Are
Joe,
you able to talk, or have you suffocated yet?
I know. Can you breathe? Can you give us a couple hand signals or something?
I think I'm here. Joe, let's go. Let's hit rewind. So what do you do all day? How do you help investors, and how do you help the investment community?
Well, I'm a investment advisor with an RIA, Zor Capital, and so I manage money for high net worth individuals and some institutions as well. And I also run an educational service at my website for people who maybe like to do it on their own, or who maybe work at funds and want access to my analysis and research. So that's what I do. I drink a lot of coffee. I eat some bacon once in a while, but other than that, I'm watching the markets and tape during the day.
And you're in Vegas, right?
Between Boston and Las Vegas. Yeah.
Got it. Okay.
Yeah.
So we like stories, and I know you've got some stories from the late 90s. I mean, you've talked about like a pure bubble when I believe you were in Vegas with a bunch of guys in a hot tub. What's that story? Like how crazy were the late 90s? Like give us your craziest story that just makes no sense today.
I mean, there were so many. I mean, my strategy in the 90s was I would look at the point gainers in the morning and see what's up $3, $4, $5 and just buy them. And at the end of the day, they were all up between $20 and $40. Wow. It was literally the craziest thing ever. Sometimes trying to get filled on something on a market order, and you wouldn't get filled for 5 points and you'd be all upset, and it would still go up 40 points that day. So it was definitely crazy at the time. There wasn't any social media or financial television where I couldn't even imagine right now if this was the 90s and social media was around back then, because people are going crazy now. And in my humble opinion, this is nothing compared to the 90s where, these companies, Sycamore and Extreme Networks and all, they'd IPO at $20, $30 and open at $200, $300. I mean, you're seeing pockets of that. I'm not saying there isn't signs of froth, but it's nothing compared to that. I mean, I wrote a blog post. I'd have to think about, crazy stories, but it was just literally just, anything. And especially in that last 6 months, from last 3 months of 99 into the first 3 months of 2000, I mean, it was hard not to make crazy money at the time. I mean, I remember a crazy story. A friend of mine opened an account with 30 or 40,000 and he bought some Qualcomm options. We're all 20 something years old.
Yeah.
I'm working at a software company and I was happy out of college making 20,000 a year. And I was thrilled. Like we don't have any money, but he opened an account and built it up to 40,000. He bought some Qualcomm options and Qualcomm went up, I think split adjusted, 400 points in one day. And he called me up. He's 20 something years old. And he's like, I just became a millionaire today. And we're like, what are you talking about? He's like, I bought some Qualcomm options. My account just went from 40,000 to $1 million in a day or two. It was insane. So, of course, a lot of us gave a lot of it back, but the whole point was, it actually reminds me of another story. We all started getting in 95, 96, and then in 97, some friends of mine that don't even know how to spell Dow Jones, that can't even tie their own shoes, they started getting involved. And we're like, okay, this is the end. Greenspan's talking about irrational exuberance and all that. And my point of the story is moves in the market can go on much longer than we can expect in both directions. Just when you think it can't go higher, it usually does. And in a bear market, when you think something can't go lower, it usually does. So moves are exaggerated. My point is a lot of casual friends started to get involved in 96, 97. And we were saying, okay, this is over. And it still went on for a couple of years. So when people say, oh, so-and-so is talking about quantum computing or so-and-so is talking about this stock or whatever, I don't consider that crazy sentiment because, again, it could go on much longer than we expect.
Well, breathe for a second here. Remember when Mila Kunis went all in on the market in 2013? Everybody said, that's the peak. Well, looking back, that was a pretty good buy signal, right?
Yeah, you can't go by what one person says.
People freaked out, though, when Mila Kunis said, go long the stock market. I know maybe older people or younger people don't know that. That was a day everybody panicked because Mila Kunis said, go in equities.
And we're just coming out of a 13-year, correction in the S&P's making new 13-year highs. So, again, I don't pay too much attention to that. The greatest sentiment indicator is just ask 10 people, what do you think of the market? And I would say 8 out of 10 right now is saying bubble. We're going to crash any day now. And I actually, from a contrarian point of view, the Livermore line of the market tends to fool the majority. I think that's very appropriate.
I mean, forget 99, right? It seems like there was more exuberance in 2021, or the end of 2020, 2020. Speaking of casual friends, uncles and aunties coming to me and saying, "Oh, what stocks should we buy?" I'm not picking stocks, right? We do like more macro themes, things like that. I was like, I have no idea. You tell me, right? But
it wasn't just. I think because of COVID and all, it wasn't just the insane. I mean, the Fed bought more treasuries in the 6 weeks following COVID than they did in 8.
The Powell going with the money printer.
Don't just fight the Fed. Don't fight Sonu's T-shirt as well. But the between all the money that was being pumped in and the liquidity being pumped in, the Fed bought more treasuries in 6 weeks than they did in 9 years combined from 2009 to 18. I mean, the liquidity was insane. That it wasn't just stocks; it was NFTs. They were running, crypto and altcoins, and they were running. It's like they were running out of asset classes at that point.
Is sentiment too bearish now, or relative to where the market is? I mean, it's not too. I mean, in April it was definitely bearish, but so we're less bearish than that. But relative to the market's up 35% over the last 6 months, something like that. Some crazy number, and
I think there's definitely froth, and I'm here to remind people, sorry for the somber, announcement. We're not geniuses. It's a bull market, and don't mistake that. I mean, there's no question it's a good market, but I think sentiment is very skittish, meaning any minor pullback, people rush to puts, rush to short, rush to go to cash. And when it's just pulling back to normal support, in my view, and I think that wall of worry is what's keeping things going. So for sure, as we run up, human beings, as things go up, they tend to get more bullish, and as things go down, vice versa. But on minor drops, on minor sell programs, I mean, people are freaking out, maybe because they're using too much leverage, but I think sentiment is very skittish right now, and I like that. I'll get worried when we drop and everyone just says, "Oh, I'm not worried about this," and I'm loading up. That's when I'll get worried.
No, I agree there. Was it 3 or 4 Fridays ago when President Trump was not going to meet with President Xi, dropped almost 3%. And the Friday after that, we saw a 29 VIX spike, yet the S&P 500 closed 1% from an all-time high. We've never, ever seen that. And I'm with you there. Now, Joe, what I like about you, there's a lot. I followed you for a long time, looked up to you for a long time. Again, it's an honor you're joining us here for 45 minutes or so. You look at, obviously, fundamentals. You talk the game, but it does feel like you're more of a technician at heart. Momentum, relative strength, kind of big picture. How do you form? And what I love about it is you can talk, we can talk. We manage almost close to $7 billion. The market keeps going up, right? You manage a lot of money. You work with clients, and trust me, managing money and saying one thing on TV are two totally different things. But I look up to you because you manage real money. How do you use technicals when it comes to finding trends and honestly making people money?
Yeah, well, thank you for the kind words. I look up to you as well, because you're taller than me. So
yeah,
every time I meet Ryan. But
hey, by the way, Sonu's older than me. Do you know that? Sonu and I are the same age, but he is older than me. I'm 47 now. I turned 47 the other day, so I just like to point out Sonu's older than me.
Right. Because age before beauty.
But
there you go. I like to keep it simple with technicals. The 50-day moving average on a weekly chart, the 10-week moving average is pretty much a medium-term area of support. So I've always said you don't need to be a CMT, you don't need to be some expert technician. I just look at it with stocks in the market. If we're above the 50-day, for the most part, a green light that the market's healthy. When we're below it, get defensive, kind of red light. When we start to break below that, and then the 200-day, as Paul Tudor Jones says, nothing good happens below the 200-day. Yeah. That's when we had the crash of 87, the crash of 29. A lot of big hits happened below the 200 days. So the technicals already looked horrible. That's why I'm never complacent. I'm not worried about a crash. Eventually there will be a bigger correction, but the technicals will show that. But simply, I just say, you know what? Just use the 50-day on a weekly chart, the 10-week moving average. They roughly correlate to the same level. If we're above that, I'm pretty much positive, constructive on the markets, involved in growth stocks. Below that, I don't care if you hand me the greatest stock in the world. I'm not interested, because I keep saying this, the big institutions control the markets. I don't control the markets. If I'm buying 100 shares, if Ryan's buying 1,000 shares, if Sonu with his huge bankroll is buying 10,000 shares, that's not going to move the markets. It's the big pension funds, mutual funds, hedge funds that are buying hundreds of thousands of or millions of shares. They're controlling the market. So if they're not supporting the market at institutionally supported levels, I want to get out of their way. If they have my back, I want to ride the trend.
Right. Now, it sounds, the 50-day and 200-day sounds like something that I can do. But I read something you wrote recently I thought was very interesting. Speaking of market signals, like using options positioning to get market signals. Talk about that, how you use that, what you're seeing right now as well.
Yeah, I think a lot of big institutions use options, and it's becoming more and more of a bigger market. And, you know, like Carl Icahn, when he bought, I think it was a 10% position in Netflix years ago, he got that through in the money calls, and he wrote it and made $2 billion, and he wrote it for a couple of years. But he built that position because it's a lot easier to buy in the money calls and get assigned the shares than telling your trading desk to buy, you know, millions of shares
and moving the market.
And you see that with activist investors. They get involved, and all of a sudden you hear they take a position. They have a 5% active, 10% active stake. So that's one example of, I love to watch option flows because that's where a lot of the big institutions traffic in. And as long as I see since April, a lot of big calls on a lot of the Mag 7 and a lot of industrial names as well. As long as I see them keep rolling them and a lot of put writing, so they're willing buyers if something drops, that's also what I add to the whole mix of fundamentals, technicals, sentiment, seasonality, unusual options activity. I'm trying to put all of that together to help with my overall thesis.
So I think listeners probably mad if I didn't ask you about the elephant in the room, gold, right? Obviously, gold's up, what, 50% this year, Sonu? It's pulled back. It was 60 about a week ago. We have had this allocation to gold really since like March, April of 2023 in our tactical models. This summer added a little bit more gold to our longer-term strategic model. So we benefited from this rally. No, we didn't think it'd be up this much, but we're not complaining because it has helped us. Joe, have you been on the gold train at all, or what do you think about it right now in a portfolio?
I'm not a big gold bug. It's not something I'm mostly picking growth stocks. I know Sonu's necklace, his net worth must have gone up because of gold. Even his skeleton's worth a lot.
Yeah, that skeleton's Mr. T back there. Yeah,
exactly. Mr. T must be a billionaire. Yeah. It's not, I mean, you guys know this better than I do. If maybe some people say I have a 5% allocation or something. I mean, again, it's a bull market. A lot of different asset classes are going up, but I'm not. It's not really an area that I get involved in.
What about crypto? I mean, up until I feel like for a period there, crypto seemed to be doing what the Nasdaq's doing. It seemed like tech and drag in a way, but it seems like it's gone sideways now, and tech is going gangbusters. Obviously, over the last few weeks.
Yeah, I don't want to say it's a crowded trade, but it's also human nature. As things go up, a lot of people tend to plow into them as they go up. And I've had a lot of casual friends get involved in crypto in the past 3 to 6 months because it just keeps going up and up. And I know the new administration is more crypto friendly and so forth. I think sometimes when a trade gets too crowded because it goes straight up, the market needs to wear out some of the newcomers because the market is not designed to be easy. Sometimes they need to shake out some of the people late to the party. So I'm still, you know, I'm not really like hardcore bullish on crypto. I'm constructive on it, but I think it just needs time. Just like when a stock makes a big move, it needs to consolidate. Same thing with crypto.
Do you trade crypto actively, like Bitcoin or Ethereum, or you know?
No, I don't trade them actively. No.
So I'm going to change things up a little bit here, Joe. A huge fan of your podcast, Happy Hour with Joe. I think it's a great title.
Yeah, thank
you. More of a, I don't know if laid back podcast is the right way to put it, but kind of, because I mean, you literally had like a lot of musicians, and I want to talk to you about musicians and music and stuff here pretty soon. You've had magicians on there, musicians on there, markets people. I thought my favorite one you ever had, I'm going to butcher it, but one of the first couple you did, it was like the producer that you work with, the guy who said, here's how you make a successful podcast. And he went through it, and it was so good. It seems like your podcast has been really, really popular. What are some things you've learned from it, and what are some tips you can give to someone like us? Honestly, we've done 160 of these. We're always still listening for tips on how to have a successful podcast.
Yeah, that was great. That was with my producer, Tyus. I actually had a pretty big guest who I showed up and he canceled. So I told him that it was impromptu. I said, look, I got a clean shirt on. You want to record?
Yeah.
So that was fun. And he produces some of the biggest podcasts in the country. The studio I record out of, there are UFC people. There's a gentleman named Sean Kelly who's got like 15, 17 million subscribers on Apple Podcasts. He is one of the biggest. There's like health people. I mean, it's really broad based. So I'm learning a lot from him and so forth. The number one thing which I need to work on is consistency, where your fans, your audience expects it at a certain time. I'm trying to do it weekly, but I'm also not around all the time. And you know, and my main business is managing money and so forth. So I'm trying to keep up with it, but I would say the best advice, whether your audience expects it once a week, every month, whenever it is, but usually the good cadence is once a week. To be consistent, show up. I love what you know, Mike Batnick and Ben Carson have done as well, where they've done what, like 400 and something episodes. I admire the consistency because that's what makes anything great, and anyone great is consistency. And that's probably the best advice for anyone starting a podcast.
No, well said. That's ours comes out every Wednesday morning, and I think people do like that. I was going to say, Andre Agassi. You said you ran into Agassi, and he's going to be in your podcast. Is it still? That would be great. Is that still a chance that's going to happen, or what's the latest?
It's still a chance. I ran into him. He was super kind. He said he was busy. I ran into him in the summer. He said he's like, let's shoot for some time in November. I reached out to his publicist, so we're still working on it. Okay. To be perfectly honest, I was trying to keep up with it every week. I've just been, it's just the truth. I've been so busy with the markets. I have to focus on my main job. So it's something where I actually ran into him again. Super, super kind. I would love to talk to him about the mental part, because I want to apply it to trading and investing, because I don't care what happened in the third set of the French Open in 1990, whatever. I don't care about any of that stuff. I would more want to ask him about, you know, the business side of it and the psychology. So,
well, I'll turn to Sonu in a second. Just one more second here. You said Batnick and Ben Carson. I don't think Ben Carson's the guy you meant. Ben Carlson.
Carlson. I misspelled Carlson.
Yeah, Ben Carson's the neurosurgeon in the Republican.
Yeah, no, they used I meant Carlson. I apologize, Ben.
No, but I will just say this, and I'll go to Sonu. I mean, I listen to your podcast, most of them, probably 80% of them or so, and they're awesome. I mean, you are an excellent communicator. Just it's like you're like a cheat sheet. I'm like, how's this guy doing this? Your third and fourth one in. It's just a great conversation. I'm a fan of it. I hope you can do more, and hopefully Sonu and I get to Vegas and we get to do it with you.
Yeah, I'd love to have you guys. You guys are welcome anytime.
But
it'd be a lot of fun.
Forward to that day. Go ahead, Sonu.
I want to come. I want to come out for the Formula One Grand Prix sometime and see that in Vegas. But no, I was just saying that Agassi's biography was fantastic.
Yeah,
autobiography.
He's got. I love stories. I love stand-up comedy. Yeah. My brother used to do stand-up comedy a long time ago. The best stand-up comics tell great stories. You know, like Chappelle being one of the best, and that's what I'm trying to get out of the podcast, is get some, like you guys asked me about some 99 stories. I think that's more captivating than talking about, you know, I don't know, the CPI report, at least for me.
Speaking of, I have a very serious question for you. I know you're a musician, and I have seen some videos, very cool ones, and I recommend anyone to check out Joe's X/Twitter feed. Which one do you prefer or enjoy more playing, Pink Pony Club or Faithfully?
I grew up playing in high school. I grew up playing drums, a little piano. When I lived in New York for 9 years, my apartment was like, you know, like 9 square feet. So I couldn't, no, I'm kidding, but I couldn't keep a drum set there. So I kind of lost touch with it, but I'm trying to get back to it. I had a lot of fun with that. I love playing music. It's very therapeutic, and I want to try to get more back into it a little bit more.
And for the audience, so what instruments do you play? Just for
I play drums and piano.
Drums and piano.
Yeah.
So another quick story. In September of 2016, I'm in New York City. AC/DC being headlined by Axl Rose is playing at Madison Square Garden. I'm there by myself. I said, you know what? I love AC/DC, love Axl. I'm going to go. So I walk into this place, and right there is Joe Fahmy. Batnick was there, Gasparino was there, and Josh was there. And they're like, hey, you want to sit with us? I'm like, well, I don't have a ticket. I'm way up there. Like, I just, whatever, sit down. So I sat there, and by the luck of God, like, no one took the seat next to you guys. So we hung out. It was amazing. Axl singing, like, Hell's Bells, and for those about to rock, we salute you. It was so good. And here's where I'm going with this, Joe. At the end of, now I'm not making this up, everybody. It might have been 9 years ago. Maybe had a few drinks with Joe, but I remember this. We go, Joe's like, I know that I'm in the back. Let's go in the back. We go underneath the Madison Square Garden. All these twists and turns. We end up in this room. It's like the post-show room. Joe, you can explain exactly what it is in a second. But all the band is there. Like Axl Rose is walking around. Scott Ian from Anthrax walking around. And I kid you not, everybody. I'm not making this up. Literally, like, everybody knows Joe, okay? Chris Jericho. I'm telling you, 9 years ago, Chris Jericho is one of the most famous people in the world, if not right now. Jericho's like, oh my God, Joe Fahmy. I'm like, what is going on? How do these people know Joe Fahmy? Like, it was unbelievable. Joe, there's not really a question here, but how does everybody know you? That was the craziest night of my life almost.
No, thank you. That was a lot of fun. That was a lot of fun.
Yeah.
I've just been very blessed to, I think it's just good karma, good networking. I love to network. The market's intense. I know you guys manage tons of money, and and it can be very intense dealing with. So I want to make sure the work hard and play hard is very important in my life. So I make it a point to get out of my house and network. And we live in a world where everything's app based, and there's very little personal communication. I mean, a really quick thing is they did a survey of billionaires, and they asked them, what's the number one thing that brings you happiness? And the number one answer was dinner with friends. Mm-hmm. And I'll tell you this, guess what? You don't have to be a billionaire to have dinner with friends. Like, we can all go out, have a couple drinks, have a cup of coffee, grab a bite to eat. And also what's amazing about that study is that you would think it would be something tangible, something like a car or a house or some sort of big purchase. But what brings them happiness is dinner with friends. And I agree with that, because we're social creatures. That's why during COVID, so many people got wound up in this and that. But I sorry to be so long-winded, but I just make it a point outside of the market to try to have a life, to try to network. I've been very blessed meeting some great people, and I try to keep in touch and network with some. And I also have some, friends and clients that are music-based as well. So
one more for me, because I could do all day on this. It seems like you and Slash are legit like friends, like friends, right? I mean, you and Slash are tight, right?
No, not friends. I've met him a bunch of times because one of my best friends plays with him. So,
okay.
He's very nice. And I also don't like to bother people. I think 20 or 30 years ago, I would have been like, oh my goodness, it's so-and-so. Now, I mean, we're all human beings. Mm-hmm. And I think maybe that's why maybe they like me, because I don't bother them. I'm not like, oh my God, can I have an autograph? Like, what am I going to do with an autograph?
Mm-hmm.
So,
yeah.
Actually, continuing along that, because I imagine like trading and investing takes so much of focus, right? And there's so much of noise, right? Oh, CPI did this, somebody else said that. How do you shut out that noise? Like you mentioned, dinner with friends, obviously something like that. But how do you actively try to shut out all the nonsense that comes our way?
It goes back to just trying to focus. If the big institutions control the market, I want to do my best every day to analyze what they're doing. My opinion doesn't matter. Your opinion, I mean, I love you guys and I love the work you guys do. I just mean no one's opinion really matters. We're just trying to interpret, and all I'm trying to do is interpret based on facts and based on what the institutions are doing. And that's how I try to shut out the noise. I know our good friend Brian Shannon, price only pays, and Tom Canfield, be dumb and follow price and all that stuff. There are companies I've absolutely loved fundamentally, and I'm thinking there are doubles and triples, and they do nothing but go down. And that's just me saying, okay, I have a thesis about a company, but I'm just dead wrong. And I don't get involved in them, and it doesn't make sense. Just like on the flip side, there's some companies that go up and people are saying, I don't get this, doesn't make sense. We're not here to be heroes and be, like separate your ego from your trading, separate your ego from your investing. We're not here to, I mean, you can be an angry bear all you want, but we're just here to do our best. That's how I shut out the noise and just keep it simple. That's it. Keep it as simple as possible.
I'll just chime this in. On the YouTube channel, the comments are open, so feel free and send a couple comments there. I did say they asked about Bitcoin and Ethereum at the end of the year. Do you have a target? I mean, we kind of touched on that earlier, Joe. Not really for you?
Not really. I don't like to BS the people. If it's something I'm not really,
Gotcha.
I'm not going to make
I did see Frank Capillary's out there. We got a ton of people watching. Yeah, shout out to Frank. Who are some people that you, besides, of course, Angry Bear and Sonu, that you look up to that have helped you in your career, that maybe someone that somebody else should look into and learn a little bit from there, Joe?
That's a great question. I mean, Mike Webster's a dear friend of mine. He's one of the investment strategists or chief investment strategist at IBD Investors Business Daily. He's been a great mentor, more importantly, a very kind soul and a great friend. And he's really helped me. He had the privilege of sharing an office with William O'Neill for multiple years. And so, that proximity of being able to listen in and pick someone's brain who's one of the best investors, traders in the world. So he's been a great influence. And I've also had some other friends that have helped along the way. I mean, it's countless, but I mean this sincerely. Like, I got to be honest, I don't like doing stuff during the trading day, but I'm doing this because I love the work you guys do. Ryan, you've been very gracious. Whenever I say, hey, can you do a quick study? You're like, yeah, give me, I'll have it to you at the end of the week. Like an hour later, you whip up the study, and it's like, I really appreciate our friendship and a lot of the studies and just your resourcefulness is I'm very grateful for that. So thank you.
Well, it's likewise. That's for sure. Yeah, you're welcome there. Go ahead, Sonu.
I was going to ask, big picture. There's no right answer over here, but still, I'll ask it anyway. How long do you think this bull market lasts?
Hate bull markets.
I've been saying 2027 with bumps along the way. So bigger picture, bull markets, and I wrote it on joefahmy.com. Bigger picture, bull markets are usually driven by inventions, big inventions that revolutionize our lives. Going back to railroads, television, airlines, internet, the new invention is AI. And what do all of those inventions have in common? They increase productivity. Railroads would help you get from New York to LA faster. The internet does things faster. AI is increasing productivity. And so that's the fuel. It's semantics whether the actual bull market started in the low of October of 22, or I believe it got started in May of 2023 when NVIDIA, the true market AI leader, had like 31 analysts and they blew out the most ridiculous numbers. It was embarrassing. That's when they really woke people up to what was going on here. We're talking about a beat in the billions. And if you compare it to the late 90s with about 5 years, that's why I'm saying 22, 23 could go about, 4 or 5 years into 2027. There's a lot of bullish options positioning for January of 2027 as well. And 28, they just started printing some of those or offering some of those. So of course, though, I keep saying this for anyone listening who's saying, oh, he's just a blind bull. And I'm not saying we're going up every single day. Sure. There's going to be shakeouts. There's going to be corrections. There's going to be pullbacks. But I still think this can go on for a couple more years.
Yeah. So one of the questions we have on the live stream was, where do you see S&P the next 12 months, end of 2026? I mean, it sounds like, you're still pretty optimistic, and it might even go a little further. Bad news, Joe, we've only got like 3 more minutes, maybe. It's amazing how fast this goes. Sonu, what else? Or Joe, you have anything for us? What do you want to talk about we didn't touch, Joe? That's maybe more important. And maybe a little bit about how people can learn more about you as well. I know we touched on it, but I want you to promote yourself here too.
No, I appreciate that. I mean, look, one of the things I manage money, and if anyone's interested, they can always obviously reach out. But, my contact information is on my blog. It's just simple. It's joefahmy.com. But, during COVID, I started an educational product, and I really enjoy that because I do enjoy thoroughly helping people to improve their confidence, to improve their calmness in the market. So you're not freaking out over every tick. We live in a real-time world where even people in their 40s are watching their IRA every 2 seconds and refreshing it. And I'm like, you can't touch it for 25 years. Like, I'm trying to remind people to, that I'm more of a stock picker, but also if it's something you can't do with stocks, just reminding people that the market every 10, 20, 30 years, if you have that time frame, That's the one thing I have no problem. It's not investment advice. It's just dollar cost averaging into the SPY or the Qs over a 10, 20, 30-year time frame. Sometimes if you don't have the time or the mental fortitude to get involved in trading, I still encourage people to get into the markets through those ETFs, whatever one, low-cost ETFs, to get involved in the markets that way.
Yeah, it's amazing. There's so much of low-hanging fruit where you can, pluck that fruit and be successful, I feel, right? Without getting too cute with everything.
Yeah, just keep it simple. Keep it simple and expand your time frame. Try to get away from the day-to-day social media, all these apps. It's just that adds to your point about the noise. If you minimize that can help keep you calm and think bigger picture.
Yeah, well, Joe, listen, we really, truly appreciate it. And I didn't even think of the fact that, your days are busy. Now, ours are too. I don't mean it like that, but just that usually you don't do these during the day. So thank you so much for taking time with us. Yeah. You set a really high bar. Warren Pies is awesome. I know you, Warren. He's next. But just thank you so much, Joe. You're a great friend. You do a lot for the industry. I love the way you add humor. We didn't really talk about humor, but you add a lot of humor to this stuff too, which is what I love. So just thank you so much. From Angry Bear and Sonu and everybody at Carson Group and the Facts versus Feelings and all the live stream. Got a lot of positive comments on the live stream. You're a legend, Joe. We appreciate it. And we'll see you in Vegas, and we'll do this on your turf, hopefully next year. All right.
Thank you. It's been my pleasure. Thanks to Tori and your staff behind the scenes for making this easy. I appreciate you guys, and we'll hopefully do it again soon.
Absolutely. Thank you, Joe. I know we've got like a little promo or thing, and we're going to come up with Warren Pies very soon.
Hey, look who's here.
We're back.
Oh my gosh.
I saw the faces going round and round in the promo. I was like, wow, that's really cool. But anyway, Warren, thank you. Nice to see you.
Great to be here. That was hypnotizing a little bit. Yeah.
Yes.
So Warren, you joined us back in March, and originally Sonu and I kicked around what to do. I said I was going to be you for Halloween. So this started it, right? This shirt. I've been working out. I've been lifting a lot to look like you, and then I said, well, you know what? I'll just be an angry bear for a little bit as well.
Warren, what's funny is I had the exact costume. You stole my costume, so I flipped this shirt on. I guess I'm like a poor man's Steve Jobs. So
there you go.
You're yourself, and that works just as well. I was trying to go with the debasement theme here with Powell going, that meme of the money printer going burr.
I see it. Yeah, that's very. I like the spinning.
Yes, the spinning dollar. Yes.
Yeah. I think very relaxing. Well, Warren, again, thank you. Welcome back to Facts versus Feelings. Obviously, this is a live stream on Halloween. Founder and strategist over at 314 Research. How you been doing? We saw you, I guess, 6 months ago or so. You've had some great calls. I want to talk about what you said 6 months ago, or where you see things now. But I mean, you've nailed it this year. How you been doing?
Man, I'm pretty good. Can't complain. Year's been, this has been. I think markets are fun because it's just always different no matter what. There's no. We like to try and relate it back to a period of time like the 90s or something like that. But this is unique in and of itself. And I do hate event-driven markets, but it's still been a good year for us. It's been, it's kept us on our toes. As a data person, I'm a little annoyed by the government shutdown, just not having the data to do the analysis. But I mean, I think it was like Joe said before me, you got to be adaptable. And so we're adapting and trying to, I think the Fed's doing the same thing. So we're all adapting at the same time in this new weird kind of world that 2025 has ushered in. But I'm good. Can't complain.
Got to ask an out of the way question because, so you've gotten to a few, I think. I don't know, maybe you've been pulled into a few X/Twitter spats, feuds. So I was curious, how do you deal with that? I mean, Ryan's always getting brickbats and things like that, but you've taken it on. I feel like Ryan ignores it. You're like, you know what? No, I'm going after these guys.
Let me jump in. Sorry, just once. Lately, I've been getting a little more aggravated by people. I don't know, Sonu. Usually, I let it roll off, but lately, I've kind of start picking at them a little bit. But go ahead, Warren.
Man, yeah, so like I think everyone who's like in the public, like this is like public on X or whatever, has a decent social media following. It's like you end up with you kind of have to evolve as time goes on. And so the core of me is a very combative person, right? Like I want to argue, and if you want to fight, I'll fight. And there's something in me that there's, from a kid, like there's a little bit of a chip on my shoulder of like how I got into this is, I didn't go to like a big fancy school. Wasn't a good student growing up or anything. Like I didn't take school serious. Wasn't from a family that had parents who went to college. So, you end up having to be a little chippy, and that's in me. But, I think kind of, not to be woo-woo, but like I like a maturation, spiritual maturation kind of perspective. I've tried to be much more disciplined in how I respond over these last few years. Hopefully that comes through. I'm happy to have debate and I'm happy to have disagreement. I think we need that. I think X is most fun when we're having like a dialogue, a respectful dialogue. But at the same time, I'm trying not to have personal attacks. I'm trying not to do like any kind of low blows and have a level of collegiality, For instance, here's like an example of something recently that happened, not for me, but I appreciated the way it happened, was we put out a chart on X where I think it's a really good chart and we can talk about it, but we look at buybacks, corporate buybacks, seasonality through a 10-year rolling period. And then you look at how this year has evolved versus that seasonal tendency. And we calculate that as a percentage of total volume traded on the S&P 500. And so the bottom line is you want to see, if you see corporations doing more than 1%, counting corporate buybacks account for more than 1% of the daily volume, it's usually good. Like when you back test it, those days are up. So if you can say like corporations are coming back strong, it can help you kind of decompose the flows of the market. So we put that chart out there, and to his credit, Mike Green, who has sharp elbows, and he's not afraid to disagree with people. And we probably don't see the market in very similar ways. But he DM'd me privately, and he's like, I don't think you're doing your math right on this. He was like, I think you may have a mistake in your chart. So we walked through it. We didn't have a mistake in our chart, but we walked through it in a respectful way and hashed it out in the background. And I told him, I was like, Mike, I appreciate that. That was a very collegial way to handle it.
Yeah.
Appreciated it. So I think it's good to have disagreement. I think it's good to be collegial. And I hope I contribute to that dialogue in a constructive way versus attacking people. So, sorry to anyone whose feelings I've heard out there. I'm trying to be a better version of myself. And so
no, you know what? Speaking for myself, I've enjoyed it. I think you've been very good at patient with responding, which is hard to find sometimes at random people on X. But no, and actually maybe that can lead into the whole over the summer. I think it was JP Morgan came out, maybe it was August or September. They came out and started talking about gold running up and the debasement trade. And I was like, wait a minute, that was Warren who first talked about that. As far as I know, the debasement thing. And but it seemed like there was so many people on X who were upset about dealing with that, right? In every, like, how can you talk debasement when yields are going down, inflation expectations are anchored, all of that. And I was like, oh, you know what? There's no better person to talk about this and ask about this than Warren. And so talk about the debasement thing and how you're viewing it.
Yeah. So that's, who cares who came up with that, I guess, somewhat, but you have a little bit of an ego. Like, I don't know who started. I can say when we started talking about it without, doesn't make me any extra money to talk about it first. But like, we have, for instance, we have a large family office, and most of they have some members all over the place, but most of them are located in India. And so they have they bring kind of an emerging market experience with them to develop markets. They've made a lot of money in crypto and in other areas of in real estate in the United States, and they're kind of global. But they look at this with an EM perspective, and we've been talking for years. We stay in contact. They're one of my regular contacts that they don't just receive the research, but we kind of consult. And so we've talked about it for a while, and I've told them, I think that what's happening, this is going back to like 23 when the bull market started and this current part of it. And I said, I think that this is a transition from deflation to debasement, and it's an investor psychology transition, because I think that we came from this period. This is the way I've said it, for whatever it's worth. I don't know how anyone else classifies it, but I believe when we left that GFC period, post GFC period, 2009 to 2020, that was a period where the primary psychic concern, is the way we say it for investors, was principal protection. Right. So they wanted to protect principal. They wanted to protect against downside, which I think is ultimately what gave rise to this dip buying BTFD type of regime we're in. So these guys, that's where I think that's where we came from. And I believe that our view is the proximate cause of the transition was the COVID era stimulus. And there's always been this debate on, whoa, was this transitory inflation? Was it supply side demand? I think that debate should be pretty much settled at this point in time. I think it was primarily deficit fueled money printing that has caused the inflation, the real painful inflation that has caused interest rates to level up and has caused consumers to have so much angst. And we can talk about how that manifests in the actual economy. But that's what happened. And now I think what people are catching on is that right tail is it can be just as scary as the left tail, if you know what I mean. Mm-hmm. And that's what the debasement mindset is like, we must if we aren't in assets, if we don't own real estate, if we don't own stocks, if we're not taking big swings, then we are going to be left behind. We won't have the down payment to afford the house or be able to afford the car that's $50,000 a year, just on like a Camry, or something, which right. I think of a Camry as like a $25,000, $30,000 a year car. It's probably like a $50,000 a year car.
It's crazy.
Right? And so that's real inflation. That's debasement. And so working with these family offices, and this has been something we've talked about for a long time, even in our writing. And then in May of this year, we wrote a whole big report called Deflation to Debasement, where we laid this psychological transition out. And so, yeah, that's the big picture thing. And then there's always a cyclical component that's going on. And I think we're in a period of cyclical disinflation against that inflationary backdrop. And these things can cause like cognitive dissonance for a lot of people. There's like a real, like, oh, you said debasement and now you're arguing that yields are going to be, and you're kind of talking bad about the higher for longer group. And it's like, yeah, both things can be true at the same time. And so that's what trips people up. But I am 100% in the, I believe this is a debasement regime that we've entered, and it's specifically manifesting the way investors approach markets.
Right. And we've been in that camp too for a few years now. And we just didn't, I wish I'd written that note about debasement. You did. So kudos. No, I thought it fit perfectly. I mean, obviously you're kind of simpatico there, but you tweeted something out today, which I think was quite important for especially a lot of listeners over here, a lot of advisors listening. Stocks are a real asset too. Stocks can protect against inflation, right?
Yeah, I mean, I think that's even more true today than it's ever been, and that's something we've talked about at length. So I tweeted that out. In our deflation debasement report, we went through all these assets, and the idea is this a bubble? And like almost every asset class has broken its like if you just run like a linear regression, they've almost all like had a trend change, like a true linear regression has leveled up. Your annual rate of appreciation has leveled up. And we did this for like all these assets across the US households, and, you know, and stocks are included in that. And in our view is that there's this traditional idea that gold or maybe Bitcoin is emerging as something is a debasement asset. But I think in this world, like where the debasement is occurring, this is my thinking, the debasement is occurring due to these, now we also coined this phrase years ago, pro-cyclical fiscal deficits, and pro-cyclical fiscal deficits that are, you know, 6 to 8, potentially 8.5% if tariffs are struck down here, you know, percent of GDP. That's a massive amount of money creation coming from Washington, D.C. every year.
Especially when we're not in a recession.
Oh, we've never seen that since World War II. Have we seen anything like we're in wartime spending right now? And when you think about the modern arrangement, like who's closest to the trough of Washington, D.C.? And it's these large, high quality businesses. And so these guys, they're going to get government, whether it's government contracts or contracts. And we made this case back in 2021 with all the stimulus that came out. We put a list of stocks together and said, let's look through these stocks to see how much of their revenues they get from government contracts. We think this is a good place to hide out over these years. And so this has been going on for a long time. But the bottom line is that equity earnings are going to keep up with these operators and their efficiency. These companies, they're ruthlessly efficient. You see that with all these layoffs in these big companies being announced. Like with AI coming, is going to give another excuse to be even more efficient. So the stat I tweeted out was that 94% of the time post GFC, you've seen S&P 500 earnings outstrip CPI inflation. And the only time it didn't was for a small period of time around 2011, 2012. We're doing that on like a 5-year rolling basis. The last 13 years, there hasn't been a single period where even with the 2022 inflation boom and earnings slowdown and all that Fed tightening, we haven't seen a single period where CPI inflation has outstripped S&P earnings. So, you know, I see this as a really great debasement alternative equities.
So we're joined by Warren Pies here on a live stream of Facts versus Feelings. Just a reminder, if you're watching this on YouTube, feel free and give questions or comments and keep the conversation going on the YouTube live channel. So Warren, when we spoke back in March, it was kind of a different world, right? The tariff stuff really hadn't started exploding. The market was weak, though. One of the things I thought was interesting, how you made some great calls back then. You said, listen, the first half this year might be a little choppy, a little weak, but the second half's going to be strong. I want to get your latest views there. But also, I thought even more so, it felt like everybody was bullish energy back then, like specifically crude oil, that crude oil is going to go higher. You push back on that in a big way, and clearly that's been another great call. What's your latest views on crude, the stock market, the bull market, anything else interesting where you're kind of going against what the crowd is telling us right now?
Well, I appreciate that. I'm glad you're remembering.
The bears are very smart. We remember these.
There you go. Well, you know, I could have been an oil bear. You know, that would have been.
That's true.
That's true.
Oil bear. I didn't think of that. I didn't like that. You're right. Yeah.
At the same time. Yeah. I'm still an oil bear, I'd say.
Okay.
And this is my background. I think that was the way I worked into macro. For anyone who's not aware, is through oil and energy. And I think it's given me a real advantage in this world. You know, I think we've done a lot of studies where it's really difficult to get this spike in yields that most of the bond bears call for when oil's going down. You just don't see it historically. And there is a real symbiosis there. And so I think having, and also understanding that the order of operations is that oil feeds, that channel does feed into fixed income somewhat. And it's not everything. You got to understand Fed and the data and everything else. But I'm still an oil bear. The bottom line, you look at things, there's a little bit of a debate in the oil world right now. There's more oil in transit right now than at any point except right after the Russia-Ukraine war started. And at the same time, you know, I had a buddy of mine, Matt Smith, he sent us this data, and I want to give him a little shout out that showing VLCC tanker speeds have slowed to a crawl. So you have these two things happening at the same time. You have crude on the water spiking to multi-year highs, which tells me that there's a bit of a big supply boom. And then you have these VLCCs, they're carrying all that crude, or about half of it technically, but it's a proxy, that have slowed to a multi-year crawl. So they're like slow steaming their ships, which tells you they might not have firm commitments for where that crude is heading. And
so
if you're
just wandering around on the oceans.
Yeah. And so what happens, you see oil on the water is what we call it. And that encompasses oil in transit, and then the classic floating storage, where floating storage play is where you buy oil, you put it on a ship, you sell it forward and store it on that ship. But in order for that to be economic, you need steep contango. In order for us to be in steep contango, you need a market that's oversupplied, and we're not there right now. So what I see when I put all this together, for the people who are maybe lost track, but when I put all this together, is I see a market that's slipping into oversupply in real time. And I don't want to stand in front of that. And so there's a lot of confusion because the curve's still backwardated, and I've seen debates and stuff like that. But I think if you have a good fundamental understanding of how the oil market works, then you'll see this and want to stay away. So I'm bearish oil. I think as far as equities, we're bullish on equities through year end. I think we're set up for a very similar end to the year, kind of like last year, which is not the most bullish explosion to the end of the year, but we didn't have a pullback in Q3. Usually when you look at those seasonal charts that show you like a real powerful Q4, you had a pullback in Q3 that feeds that Q4. So I think we're more looking for like a drift higher in Q4 in the equity market. I think I have an eye on yields. We've been bullish. They've done basically what we said they were going to do, and the Fed has done basically what we said they were going to do. Powell pushing back on that a little bit, but my best guess is that yields will still finish the year lower than where we're at right now, but we're about at fair value across the curve in my view. So and as far as risk, we can talk about those and everything else, but that's kind of the 30,000, 40,000.
Well, that's good. I do want to shout out. Let's see here. We have Larry Sprung. Thanks, Larry, for watching. And I see Jake Gutman. I'm going to read a question. This is Jake being Jake here. In efficient markets like Pimp Daddy Sonu, king of strategy, but with the seemingly widespread consensus of bull markets until 2027, do we look at adding any buffered ETFs in today's world? Do you have any strong feeling on that?
Actually, I'll seg that into.
Shout out to Jake. Jake's always he's our buddy. Good. Thanks,
I'll seg that into, and we can combine this, Warren. You're just talking about yields, right? And in the normal broadening out the horizon, thinking about debasement, you would think, okay, maybe underweight bonds generally. Forget the near-term aspect of it. We've had duration too, benefited from that. But generally you think, bonds should protect against equities. And you think in a debasement regime that shouldn't happen. But then do you protect using things like buffered ETFs, for example?
I don't understand why you use a buffered ETF. I don't want to step on anyone's toes because I don't know what it is.
Sure, right. No worries. I mean, I'll give my thoughts too.
It's not my cup of tea, like it's kind of similar to there's different basic option strategies that you come across, and like I think part of your education again into markets is becoming enamored with options at some point in time and thinking you've found something really cool, or that's going to give you a shortcut. And you can gamble and become right, but like, I don't know. I'm just not a big fan of selling calls or writing puts and burning money on insurance and things like that you end up doing. My thing is more portfolio construction. So you identify a macro risk and then you construct your portfolio to align with that macro risk. And so like, I see us as, again, not to talk out of two sides of my mouth, I think in a debasement regime, you're going to be hard pressed to have a recession. However, I think that, and so the real risk, most common risk in that regime is a Fed tightening cycle or yields backing up. And so that's what I'd be primarily focused on over like a 5-year period. But right here and now, I think recession or growth is your bigger risk. And the Fed's giving you the all clear. And I think that the cyclical disinflationary tailwinds we've seen, oil, shelter inflation, and wages are all going to continue to exert downward pressure on yield. So my worry is more for growth. So if you're looking at that while still being bullish, I think you still want to lean towards duration in your portfolio. And if we get a growth scare, I think you see yields, 10-year yields probably go down. 50 basis points in a pretty big hurry. You'd see the yield curve flatten. We've studied these periods. You get like a single digit correction on the S&P 500 with more volatility. So you want to have a portfolio that thinks about that probability as a larger probability than, you know, maybe consensus expects and plans for it. And I express that with an overweight bond position, underweight in our view of commodities here, because most commodities are tied to oil. And that's been our positioning all years. Like, we want to have a full equity or overweight equity exposure. And we hedge that with fixed income, with a duration exposure. And how are we paying for that? We're paying for that with an underweight commodity on the broad index level position, because most of that commodity, the broad index commodities, are energy commodities, are based on trade. So it's like crude oil, heating oil, natural gas, all that stuff.
No, we're in the same camp too. I mean, in the sense that, you know, Ryan and I both started our careers in the financial industry through like options as modeling volatility and things like that. And yes, it's easy to get very enamored with this stuff, but I'm generally not a fan of capping upside, especially more so now, right? And then manage risk with asset allocation, right?
Yeah, we just talked about how the right tail is the part that's explosive in a debasement regime. Like, we're all wondering where this ends. And like, we wrote our report last year, S&P 7000, and people threw tomatoes at us. We just wrote another one, just kind of like appending that research and saying, okay, what are valuations looking like? And it was S&P 8000, and we're looking. I think we're gonna be hard pressed if the analysts are right to get a meaningful drawdown. And I would bet, big picture bet, is that we're gonna drag more skeptics and bears that are in the bubble camp over to this new regime camp. And by the time that side of the boat, the new regime, valuing things in new creative ways, it overweights the bubble camp, then it'll be time to flip, you know?
Yeah. It's that classic cycle. Speaking of that cycle, I mean, you had something, you sent us a report, I mean, this morning, which I thought was very interesting. Everyone's talking about, there's no breadth, and there's a Hindenburg Open, which I have no idea what that is. So set that aside, right? But, you know, breadth is, having a problem. But you're like, we've seen this, you know, you wrote about the message from the guts of the market, but we've seen this. AI leads, then breadth weakens, then the rest of the market comes along. It, you know, sort of puts down those breadth concerns, and then rinse and repeat, right? So talk about that.
Yeah, we had a Hindenburg omen last spring too, you know, and we had a little wobble in the market, and everyone
what is
nervous.
that?
I can't remember the exact parameters, but we coded it up and then studied them, and like we studied them, and they actually happen quite frequently. You got to, if they cluster up, is what we found. That's more of a problem, and I can't remember the parameters, but it's basically a bad breadth type of reading.
I'm pretty sure it's if you have stocks, a handful of stocks making 52-week highs and a handful of stocks making 52-week lows. So you have like this kind of split market. And obviously and my favorite thing about the Hindenburg is the guy that created it. I remember this article. He's passed away. I forget his name, but he's literally in the Wall Street Journal with a gun, and he's like shooting a gun, but he's blind. He's a blind guy, and he's talking about shooting his gun, but he came up with the Hindenburg. You can find the article. It was probably 10, 15 years ago. I just always remember that when I hear the Hindenburg omen, the blind guy shooting a gun. So I don't know about that one.
That could have been a good Halloween costume. So
yes,
maybe
that's true.
You could have just put a Led Zeppelin t-shirt on, and then like put it out there.
That would have been more creative than I am, obviously. Yeah, so I mean, I think that's been the pattern in the markets since the AI trade burst onto the scene. Is that, you know, we're in a tech-led, which happens to be mega cap-led market now, and so you're gonna, when that's the leadership, they come out to a lead, and then the question becomes, will the rest of the market follow? We've had we call these breadth divergences, or mega cap divergences. We've looked at multiple ways, and there's all these rules of thumb, but the bottom line is just you need to see over a certain period of time, historically, the rest of the market come up to meet that the leadership group if you want to see a healthy bull market continuation pattern. And so, like, one rule of thumb is if you get a new high on the S&P 500 that's not confirmed by the S&P equal weight, you have like a 90-day clock where the S&P equal weight needs to come through and make a new high. And that's happened a number of times this cycle. We call it out in real time when it happens. We watch it, and then sure enough, breadth expands. So that's the pattern of markets that we've seen.
I'll just chime in. I mean, so you're in Florida. I saw your governor DeSantis actually tweeted literally yesterday about the market being led by only AI. And I'm thinking to myself,
really?
I swear, when governors point that out, I'm like, okay, well, breadth is about to expand. Call me old fashioned, call me a contrarian, but that's what I thought. How is life in Florida? Which part of Florida are you? Where are you?
I'm in the Sarasota area. Technically, Lakewood Ranch is like, but it's like a bedroom community, yeah. And so it's great. We actually had our first cold front, and so it's like we got into the 50s, and so I mean, this is a part of the year that we live for down here. Is like the heat breaks. So there you go.
And I didn't realize this. We're on LinkedIn Live. I knew that, but also you can actually ask your questions on LinkedIn. I see Michelle Randall sent us one. Thanks, and Steve did also. But I think we kind of answered those as well. So we've got a lot of people watching various different places live. I don't know. We've probably got 10 minutes or so, Sonu? 10, 15 minutes. What else you want to talk about?
Actually, let's go to the economy. I think now I feel like there's two camps. There's always three camps because either you go up, sideways, or down, right? Like right? But now it's like, what else is there, right? But now it seems like there's a clear bifurcation. There are things are going to get really bad, right? Look at the labor market. But then there's the reaccelerationists, right? We're going into where are you and how are you looking at that?
Yeah, that's I've looked really hard for the reacceleration. I just don't see it yet. So I'm in the muddle through is what I call it. Slow down camp. Like, so one of your guys' friends and his friend of mine, and we'll chat on Bloomberg occasionally, is Neil Dutta.
Shout out to Neil Dutta.
So Neil's Neil's a buddy, and we compare notes and stuff. And I think he might be like the quintessential, like he's very nervous about the economy. It's the impression I get. Don't want to speak for him, but I'm more in the muddle through. Like, I do think growth is decelerating, but there's some offsets. I think that the wealth effect is real. It's probably overstated by a lot of Brian. You need to stay hydrated in that bear.
Yeah, I heard Neil. That's what the
guy. Oh man. Okay. So I mean, I think that there's an offset. There's an offset for the for the wealth effect and things like that. But I just don't see. I don't see a real reacceleration yet.
By wealth effect, you mean like the market's gone up from Liberation Day things went down, so it's come back up. But let's year to date, right? Another 17% year on top of two other 20% plus years. And that creates a big wealth effect. That's what you mean, right?
Yeah, we look at like equity wealth as a percentage of GDP. I think we had a 14% increase, and that's meaningful. And like you can calculate like the pass through. I mean, it's a big deal, but it's not evenly distributed in the economy. That's for sure. It's a low propensity to spend group and all that stuff that the economists would tell you. So I look at we talk about this. Like, I think the housing market is a really good barometer of in loan creation in the private sector of like, are conditions restrictive or accommodative interest rate conditions. And we have not seen, despite the fact that yields have plunged, we have not seen the housing market really catch a bid. You haven't
seen a pickup in mortgage applications.
No, and even more concerning than that is home builders have been just traded like garbage since especially since, I think this is something we pointed out in that report I sent you, since the August payroll report. Last payrolls report we got, it's a pretty weak payrolls report, and the market has shifted into a decidedly anti-growth posture. So you see like home builders, consumer cyclicals, all in the basement, and AI really supercharging the market. I think and that's against the backdrop of yields generally falling. So to me, you would expect to see falling yields. You would get a rotation. If we were having real reacceleration, you get a rotation into those areas of the market. And we just don't see the data, don't get all the data right now during the shutdown, but not seen in the market either. And there are ways there are things you could make arguments on the other side. But when we break it all down, I just think this is a muddle through deceleration, not a reacceleration world that we're living in.
There was that famous, I think it was a paper saying that like housing is the business cycle. And that's part of me that always has looked at that in that way. I mean, housing leads, housing starts, and permits, and then coming out of a recession, they're the first ones to come out as the Fed drops interest rates. That's your signal that things are improving. But now I feel like, there is that housing started being stuck for so long, right, since 2022. and it sort of confused things. And then you have, this whole AI thing happening, investment spending, this boom happening on the other side. I'm like, wait, is that the, temporary business cycle now?
I think that that's one of those offsets,
Right.
like you're having these, I think it's a bit of a crowding out phenomenon, whether crowding out from AI, crowding out from government spending. I know that, there's like, the truth is like we have mortgage rates that don't fit the housing reality. And why do we have that? Why do we have mortgage rates that don't fit the housing reality? I think it's because too much stimulus from the government, plus the AI trade taking up resources and things like that. And that's created the angst that's out there. I think amongst voters, you see a lot of angst still. We talked about this in July. We looked at it and said pre-pandemic, it took the 40th percentile household income to afford a median home in the United States. Post-pandemic, the 60th percentile. So that's the classic middle class, 40th percentile to 60th percentile. That 20% has gone from being able to afford a home to not. And now you want to know, well, why is there so much angst out in the world?
Or they can't move, right?
Yeah, GDP is great, GDP, but you can't eat GDP. And that's what that 20% is telling us, is just those benefits, that GDP is not accruing to us, those benefits. And so it's a real problem. I think that's part of this debasement world. That's why you see those people feeling more desperate. They have to speculate more. They might even gamble more depending on their strata and things like that. And so, it's kind of a vicious cycle.
It's part of that BTFD trade, right?
Yeah. Like I said, I told this story back in April. I've told it a few times. Like, I could tell, like, that was one of the things that got me to write about it in May, was in April when everything was selling off. And you would expect the average person to be kind of freaked out. I mean, truthfully, when I was talking to clients, people were pretty freaked out.
Yes.
They were like, this is the end of the de-dollarization. And, look, these flows that have supported the market are drying up. You know what I mean? And when I went to my son's football game one night. It was a Friday football game. And the parents, they kind of know what you do and like you're on TV and stuff like that. So they bad time, they gather around you. What's the market doing? All this stuff. And I was like, I don't know. Blah, 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 whatever I said. But they all were like, I wish I would have bought more. I wish I would have bought more. Like they were all ticked that they didn't buy more when it was weak. And so to me, I was like, that's different. These guys are aggressive. And I think it kind of foretold what happened, where I think retail led this. Retail and corporates led us out of that they set the bottom back in April, and then the institutions have chased, which is really weird.
It's something we've talked a lot about. Retail's done well during this rally, and hedge funds and institutions have trailed. So, Warren, we only have a couple minutes to go. Tell us a little bit more about 314 and why some of the listeners, whether it be retail or financial advisors, should look into what you guys do.
Sure thing. Yeah. We are a research shop. That's what we do. It came from everyone who works at 314 had previously been at Ned Davis, and we started this. And, I linked, from LinkedIn, they give you like these work anniversaries. So we just passed 5 years. We're doing this 5 years.
All right.
And when we started, I said, to Fernando, who's like my best friend and business partner, I was like, we really need like 5 trips around the sun to know what we're dealing with here. We need that. And so we've gotten it. And I'm just like so blessed and so happy with how it's gone. And it was like the best decision to start the company. I get to meet people like yourselves, have conversations, have really cool clients. And ultimately, like, people pay to understand what we think, which is such a privilege. So I'm extremely, extremely happy with where we've gone. I know that's not exactly what you asked, but you can check this out if you're interested at 314research.com. That's the number 3. And then you spell out 14 research. You can follow me on Twitter if you don't want to pay, just want to get an idea of how we see the world, just very vaguely. We've been running models for years, and now 2 of them are ETFs. So if you would like to invest alongside of us, we have one that's an asset allocation model, a real asset allocation model that is ticker symbol RAA. And then we have an equity selection strategy, full cycle trend, FCTE. That has had a rough year because it's a quality-based fund. It's equal-weighted, quality-based, and so you're in this cap-led, and it's not very AI exposed, cap-led, AI-driven market, and it's just been tough. But these things tend to rotate, and it's a factor strategy, and that's how it goes. And if you want our discretionary thoughts and how our macro strategy, you subscribe, and you can get it that way. And so that's the breakdown. That's what we offer. And we're institutional. Our clients are hedge funds, family offices, RIAs, and that's in asset allocation, just any major institutional asset allocator. So that's what we do. That's everything is data driven. I don't know, like Joe said before me, like he's not a bull or a bear. I think that's kind of how we are. We try our best to be like evidence-based. What I thought was cool before we get off that Joe had mentioned, and it's something I reflect on a little bit, and we talked about this at the beginning with the Twitter beefs and stuff like that, is like the more you study the data and history and go through this process and see enough reps, the more you realize the real value add is a strong mindset, is the right mindset, an objective mindset, the detached mindset. And Joe reflected that, I thought. He's like a classic kind of legend. And he talked about just using moving averages and ultimately controlling emotions. And, I think that there's a lot of wisdom in that. And so, hopefully we reflect the same kind of disposition.
No, well, Joe's a legend, and you're a legend too. So, Warren, we really appreciate you. I think last time you joined us actually was St. Patrick's Day.
St. Patrick's Day in March. Yeah,
before March. Well, we were dressed up for St. Patrick's Day. So every time you join us, we're dressed up. How about that?
It was one of our joint clients or joint contacts tweeted out the screen grab or sent it out to their clients. They're like, we want to send this out to clients because we're working with 314 now. And they screen grabbed that one from St. Patrick's Day where you guys had Photoshopped a green leprechaun's hat on my head.
Oh yeah.
I was like, what a great, they're sending this out. Like, look at our
look at this guy. Look at this serious guy.
Thank you for not suing us for doing that without, I don't know if he asked your permission, but
No. Did you get?
Well, I will say this: the last time you joined us, that was the record number of YouTube views we ever had. Now, JC Pretz beat you, but we've also grown bigger since then. But we joke the algorithms love Warren pies, so
yeah,
that's
well,
that was really
it's good. Warren crawled so JC could walk or something like that.
There you go.
Maybe
well, Warren,
a happy hour sometime with you guys, and speaking of dinner out.
No, I've done JC's show. I don't think he was on it, but yeah, I'd be happy to hook up with you guys.
Perfect. All right, well, Warren, we'll let you sign off here. Sonu and I are going to talk a little more, wrap things up. But thank you so much for spending time with the Facts versus Feelings podcast today, live stream on Halloween. Enjoy the rest of Halloween, Warren, and we'll chat soon. Thank you. We'll see you.
Man.
Thanks,
see you
Warren.
guys.
Appreciate it. All righty, well, there we go.
Are you like hot?
A little bit. Took that off a little bit, I think. Yeah, it's kind of, I'll let you do most of the talking when I was wearing that thing, Go ahead.
No, I was good. No, it was great. The conversation went, in places like we didn't plan for. I mean, just so that everyone listening, it's not like we sent them questions before this.
We didn't have anything. There was nothing planned.
Yeah, this is like just a coffee shop thing, and like we just get together, we're chatting, right? We want to learn about how they do things they do, and the conversation with Joe, and then again with Warren, like being disciplined around this stuff. I mean, I'm sure people look at, especially more you than me, but both of us, they're like, oh, these guys are perma bulls, right? No, I mean, yes, we're bullish, right? We make no, qualms about that. We're bullish, but we think about risk management as well, right? I think that's the general theme. This is a bullish market. You want to kind of ride that. You want to ride that wave, but don't get overextended. Think about risk management. Don't get over your skis in any one particular part of the market. Don't get caught up on the other side of it being bearish as well, thinking everything's going to crash, right? So ride that wave, but be careful. I think that's a general theme, if that makes sense.
No, that makes a lot of sense. And again, I mean, we thought about who we wanted for the live stream, and those are two of the best that have been right. I mean, yes, those are two of the few bulls that were around the last couple of years, and they're still pretty optimistic. I think both of them, if you listen to what they said. So that was great. So no, I think we're at the end. I think we've made it. It's an hour and a half. It goes fast.
We kept it on time.
We did good. I think we did pretty good. Yeah. So thanks to Tori on our marketing team, David on our team as well. I'm sure that Josh probably helped. I'm sure there's more, but I know they helped a lot get this all out there and through. And thanks to everyone out there. We saw a lot of numbers, a lot of interaction. So thank you. A lot of people were laughing at the costumes when we first started. I got some comments.
So are you going out tonight for trick or treating? What's the deal?
I'm not sure what I'm doing. I don't know. I think
I'm go out now, or do they just?
Well, that's the thing. Both my boys want to go to different neighborhoods. I think Susanna has her team made the playoffs, so she's got a football game for cheer. I think my wife's going to go to that. So I think I'm just home with the dogs. So maybe I'll wear my bear mask.
Wander around the neighbor in your bear costume
and hand out candy dressed as a bear. Go figure.
Unless somebody hands out carrot cake. Right.
Oof, yeah. Well, carrot cake, chocolate cake. Yeah, those are some bears. Bears love that stuff. That's what I've heard. So yeah. All right. Well, listen, everybody, thank you so much for spending time with all of us today on Halloween for this special live stream edition of Facts versus Feelings. It was a lot of fun. We love doing these live streams. Hopefully we can do some more, but definitely continue to listen to the regular Facts versus Feelings podcast, which comes out every single Wednesday, wherever you get your favorite podcast. We've got a great community doing these. We really appreciate it. With all that, everyone have a happy and safe Halloween. And we'll see everybody very soon. And the next podcast comes out Wednesday morning. So we'll see everybody then. Take care. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.